In this episode from Macro Horizons, Ian Lyngen and Ben Jeffery bring you their thoughts on the U.S. rates market for the week of August 25th, 2025, and respond to questions submitted by listeners and clients.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes.
In the week just past, the Treasury market did a very good job of holding a defined trading range, even as the equity market started to cheapen somewhat. Now, at the end of the day, it is the middle of August. Choppy trading conditions were clearly evident, and the market is very much in the mode of waiting to see how the economic data of August plays out. Now, clearly, first up will be the September 5th release of non-farm payrolls. That is data for the month of August, then followed by CPI on the 11th of September. Keep in mind that all of this information will not only be in hand for the Fed and the market, but will also presumably be traded to the extent that prices will reflect the probability of a September rate cut. Now, there's clearly been a lot of chatter about the potential for an outsized move, a 50 basis point cut to start the process. We maintain that while anything is possible, the reality is the Fed would be better served to express their dovishness in the form of adding an additional rate cut for 2025 compared to the current messaging of just 50. Now, that would be simple to do by lowering the Fed funds projection for the end of this year in the dot plot. The presumption is that given that there will only be 2 Fed meetings left at that point, the SEP will be more accurate compared to the beginning of the year when there was so much uncertainty insofar as how the real economy might respond to the trade war. With this summer's information in hand, the Fed can have a degree of confidence in beginning to recalibrate policy rates lower, although that being said, simply restarting normalization doesn't mean that the market or the Fed knows where the process ends. Whether that's 3%, whether it's 350, whether it's 250, will largely be a function of how the real economy continues to perform over the course of the next couple quarters. Keep in mind that given the lag of monetary policy actions, the decisions made during the balance of 2025 won't really come into play until we're comfortably into 2026. The one caveat with this observation is that risk assets, particularly the equity market, will respond to the Fed's actions, and that could subsequently influence the real economy via the wealth effect. In the event that the Fed disappoints the market's expectations for rate cuts between now and the end of the year, it's not difficult to envision lower valuations in the equity market. For the time being, however, the feedback loop between the Fed's actions and equity performance seems to be well in place. In the week just past, we also clearly heard from monetary policymakers at Jackson Hole. The message was clearly one of dovishness. It's also worth highlighting that the $16 billion 20-year auction stopped through. Now, it was a very modest stop through, but for a sector that has driven outsized price action in the past, we'll point to this as yet another example of the absence of any evidence of a buyer strike in treasuries. We are comforted by the fact that earlier in August, when we had 3 tails at the 3-year, 10-year, and 30-year for the refunding, the market didn't subsequently sell off. Instead, it seems fairly clear that the market has moved on from any true demand concern for treasuries.
Well, frankly, it was never going to be a particularly exciting second to last week of August, and especially given the timing of Powell's Jackson Hole speech, it was going to be unlikely that anything game-changing was going to materialize in the Treasury market before we heard from the chair at the Jackson Hole Symposium, and more or less, that's exactly what played out. We saw a mild period of bearishness in the Treasury market, with 10-year yields drifting back toward the top of the range, but still remained well contained at the support level we'd been tracking, which was the 100-day moving average, and frankly at this stage, one could even make the argument that the positional backdrop in the US rates market has become much more neutral as well. Sure, that still leaves a steepening bias intact and a general bearish sentiment toward the long end of the curve, but with the highest initial jobless claims reading of the cycle, combined with the already present angst surrounding the labor market, it's unlikely that we're on the cusp of a material bearish repricing. If anything, from these levels we favor a dip buying bias as we continue to eye 4% 10s as the next stop toward our year-end target in the benchmark of all benchmarks.
And the real debate isn't the extent to which the Fed begins its cutting campaign, but frankly, where it ends the cutting campaign. Are we in an environment where we should expect that the Fed quickly gets us back to 3% or whatever they define as neutral at the moment? Or are we seeing enough meaningful economic headwinds that we should assume that there's a path to go below 3%, let's call it 2.5% or even 2%. The prevailing wisdom is that one would need to see a pretty significant economic slowdown from here to get the Fed comfortable dipping below neutral. And in fact, given the cross currents of economic performance, the fact that we're still as restrictive as we are speaks to how hawkish the Fed has been. And frankly, given Trump's criticism, that's a credit to Powell's commitment to central banking independence.
And we also got a reminder of the, let's say, external factors that are playing a role in the market's outlook for the Fed, with headlines suggesting a DOJ investigation of Governor Cook, adding to the building or built sentiment that exists around the fact that going forward, a more dovish policy stance that arguably was already going to be the case given the developments in the labor market is going to be exaggerated by more active political pressure given the administration's desire to bring rates lower. And so, as we think about our aforementioned dip buying bias, this is yet another factor that should keep some upward pressure on the shape of the curve over the longer term, and especially in the front end, limit the scope of any backups in yield from here. But it wasn't a universally dovish week as it related to developments on the Fed front. We did hear from Hammock that she doesn't see the case for a September cut, and we also saw in the minutes from an admittedly stale July meeting before the latest NFP and CPI prints that the committee viewed upside risks to inflation as outweighing downside risks to the labor market. Sure, that take is rendered somewhat moot by what's taken place over the course of the last month, but nonetheless, in terms of setting the Fed's departure point heading into August and what was the groundwork for what's probably the setup for a September rate cut, it's notable as the idea of a 25 or 50 basis point cut continues to be debated that at the end of July, the Fed was not necessarily convinced they needed to be cutting in September.
And embedded within that uncertainty is this idea that what if the revisions to payrolls that put June as the lowest recent print really do mark the bottom, and in July and August, payrolls improve, and that would set the September meeting up to have an entirely different tone. Now, this brings us back to one of the key facets of the market at this moment and the policy outlook, and that is we're very, very data dependent. And we're data dependent in a way that is typical for when the Fed is about to start some new course of monetary policy, whether that's hiking, cutting, easing, or shifting to a pause. So with this backdrop, it's been somewhat surprising that we haven't seen more volatility in the Treasury market. I think to a large extent, what investors are saying is that by and large, we know how the Fed is going to respond to the trade war, and it's not hawkishly. Instead, it's a refocus on the employment aspect of the dual mandate.
And with this week's tips auction as the latest example, frankly, it made sense to see such strong sponsorship for inflation protection, given the backup we've seen in real rates and, exactly what you touched on, Ian, an environment where the Fed is more inclined to respond to the employment side of the dual mandate, all while the upside risks to prices persist. So it's an environment where a less restrictive central bank is meeting the backdrop of a still okay growth environment and the implications on consumer prices from tariffs, which will likely continue to benefit tips as an asset class. It's also, on the supply front, worth mentioning what we saw at the 20-year auction, which stopped effectively on the screws despite coming at the low yield marks of the day. This represents an important inflection point in the narrative around the Treasury market, on the supply front in particular, given that the concern around 20s and the potential for the great term premium bear steepening trade to play out in the wake of the election has now done a 180 as Bessent has made it very clear that he's reluctant to increase long-end auction sizes, especially 20-year auction sizes. And while we think it's unlikely the next move in 20-year auction sizes will be lower, it certainly is reasonable to assume that the newest benchmark will not keep pace with any increase in borrowing further out the curve, even if that doesn't take place until the later part of next year. And so Besant and Mnuchin as well were probably encouraged to see a solid 20-year refunding result after 3 consecutive tails, and even if the newest bond remains the least loved benchmark, at least this week's auction went okay.
It's also important to keep in mind the feedback loop between the equity market and the wealth effect and what that could mean not only for monetary policy, but also for the way in which Washington has been responding to either corrections or rallies in the equity market. It goes without saying that thus far, at least, the administration has been emboldened by the performance of risk assets, and in the event that the Fed underwhelms on the rate cut front, that could set up equities for a very precarious September.
But unlike in paradigms past, where the performance of equities would have been enough to inspire a tone change from Powell, at this stage the outright level of stocks and the fact that the small amount of weakness that we've seen has hardly approached anything on the scale of an increase in volatility we would need to see to get a reaction from the Fed, it's less likely that even a 10 or 15% pullback in equities from these levels would be enough to inspire the Fed to ratchet up its dovishness even further. After all, July's payrolls print served as the catalyst to really drive the change in sentiment around the idea that the easing campaign is kicking back off and a September cut and whatever comes to follow in the later part of this year and into early next is going to benefit equities. And that's why we've seen the S&P 500 reach record highs and pull back slightly, but to zoom the chart out, it's hardly on a scale that would require the Fed to be even more dovish and really put the possibility of larger cuts on the table in the near term. For that, we'll need more labor market data.
I concur and will reiterate that I think it really does come down to the economic data and specifically how the performance of the labor market plays out during the month of August. Recall that August saw the full implementation of reciprocal tariffs. Now, clearly we've yet to see this fully play through to the data, and even with August data in hand, the Fed won't necessarily be convinced of the full extent of the fallout, although at this stage that's clearly not a precursor for lowering rates.
So what you're saying is winter and cuts are coming.
And not a moment too soon. Jay? In the week ahead, it will be the final trading week of August and all that implies, specifically choppy trading conditions as well as limited conviction as a theme. We will have month-end influences, keeping in mind that it was a refunding month, and so there should be solid duration extension demand. There are also the 3 final auctions of August, the $69 billion 2-year, the $70 billion 5-year, and the $44 billion 7-year. All of this will create sufficient cross-currents that we expect will keep the Treasury market in a very comfortable and defined range. Now, it's worth revisiting that our core calls for the year remain intact. 2's 10 steepening, 5's bonds steepening, with the 10-year sector anticipated to end 2025 at 3.85%. Now, at one point, this was a far more dramatic call, but as the economy has evolved as it has, monetary policymakers are biased to resume normalization, and inflation, while showing some signs of pass-through from higher tariffs, has been relatively well contained, the path to 385 seemed far more readily achievable. Keep in mind that on Friday, we have the core PCE numbers. These are for the month of July. And given the combination of core CPI, core PPI, and import prices, expectations are for a high 0.2 or a low 0.3. Now, this is certainly consistent with our read that the trade war thus far has yet to bring us back to 2022 or 2023 magnitude core PCE moves. Nonetheless, we have not fully achieved the Fed's target. Said differently, while inflation might be sticky on the upside, we're not seeing a true reacceleration that would get us worried about a wage inflation spiral higher. All of this suggests that the takeaways from the week ahead will result in a classic August placeholder of a week that does risk more dramatic moves in yields, but at the end of the day, when cooler heads prevail, Following the Labor Day market closure, we expect that 10-year yields will settle comfortably in a range centered at 4.25 until we get the marquee fundamentals on the horizon in the form of non-farm payrolls as well as core CPI. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And while it is tempting to conclude simply, wake us up when September ends, even that might be too soon.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries. For BMO disclosures, please visit bmocm.com/podcast/disclaimer.